In June 2025, the Federal Reserve stunned financial markets and everyday Americans alike by unexpectedly holding its benchmark interest rate steady at 4.25% to 4.50%. This move defied widespread expectations of a rate cut, which many investors and analysts had been betting on for months. Instead of the relief markets were hoping for, the Fed's message was unmistakable. The battle against inflation is far from over, and the economic landscape is proving to be more unpredictable and complex than anyone had forecasted. For millions of Americans, this means that borrowing costs for mortgages, car loans, and business expansions will remain elevated, putting continued pressure on household budgets and making it harder for families and entrepreneurs to plan for the future. The Fed's stern and cautious tone marked a clear shift from the optimism seen earlier in the year as new economic challenges and uncertainties have emerged both at home and abroad. For most Americans, this means continued pressure from high credit card and mortgage rates, making it more expensive to borrow for everything from homes to everyday purchases. On the flip side, savers are seeing some of the best returns on savings accounts and CDs in years, offering a silver lining for those able to put money aside. The Fed's decision reflects a complicated mix of global and domestic forces, including the impact of new trade tariffs that have raised costs for businesses and consumers alike, as well as a surprisingly resilient labor market that continues to add jobs and keep unemployment low, even as other parts of the economy slow down. The Fed's move makes it clear that policymakers are not ready to declare victory over inflation, nor are they willing to rush into new stimulus measures that could risk reigniting price pressures. In this video, we'll break down the key reasons behind the Fed's surprising decision, explore the factors that influence their thinking, and explain what all of this means for your money, your loans, and your financial plans in the months ahead. Plus, we'll look at what could finally prompt the Fed to change course and lower rates. Let's dive in and unpack the Fed's big surprise. Early 2025 was filled with hope and anticipation. Analysts and investors across Wall Street and Main Street expected the Federal Reserve to start cutting interest rates by summer, believing that inflation was finally under control and the economy was on a steady path forward. Forecasts from major banks and economic think tanks predicted up to 3 rate cuts, fueling widespread optimism that borrowing costs would soon fall, making it easier for businesses to invest and for consumers to spend. The Fed's own projections seemed to support this view, and the prospect of lower rates sparked a powerful rally in the stock market, boosting business confidence and encouraging risk-taking across the financial sector. But as spring unfolded, the economic picture grew more complicated. Inflation proved stubborn, refusing to fall as quickly as hoped, and new risks, like global supply chain disruptions and rising energy prices, began to emerge, forcing the Fed to shift its tone from patient to cautious. By June, the Fed's closely watched dot plot revealed a dramatic change. Only one possible rate cut for the year, with many officials now projecting none at all, signaling a much more hawkish stance than markets had anticipated. This sudden pivot from dovish optimism to hawkish caution sent shockwaves through financial markets, upending expectations and leaving investors scrambling to adjust their strategies. Fed Chair Jerome Powell made it clear in his press conference that future policy decisions would depend on clear, sustained evidence of cooling inflation, not on a preset timeline or market expectations. The message was unmistakable. The much-anticipated summer of rate cuts was effectively canceled, replaced by a cautious wait-and-see approach that left markets and businesses in limbo. Investors and businesses now face a new reality, one defined by uncertainty, higher borrowing costs, and the challenge of navigating an environment where the path forward is anything but clear. The Fed is making it clear: inflation must be truly tamed, with unmistakable progress, before any easing of monetary policy can even be considered. A new wave of U.S. tariffs on imports, especially from China, has complicated the Fed's job. These tariffs raise costs for American companies, who often pass them on to consumers, creating fresh inflationary pressure. Unlike demand-driven inflation, tariff-induced price hikes are harder for the Fed to control. Raising rates won't make imports cheaper. The Fed is now forced to wait and see how much of these costs get passed to consumers and how much businesses absorb. Chair Powell has signaled caution, warning that premature rate cuts could worsen inflation and damage the Fed's credibility. While other central banks are cutting rates, the Fed faces a uniquely American challenge: inflation risks from trade policy. As a result, the Fed is holding rates steady, prioritizing price stability over immediate relief. The hope for lower borrowing costs is now on hold, a casualty of global trade tensions. The Fed's hands are tied until the inflationary impact of tariffs becomes clear. The main reason for the Fed's hawkish stance? Inflation just won't quit. While headline inflation has dropped from its peak, progress has stalled, with core inflation stuck above the Fed's 2% target. Service sector prices, like housing, insurance, and healthcare, are rising faster than goods, fueled by a strong labor market. This sticky inflation is harder to fight and has eroded the Fed's confidence in a quick return to normal. Recent data has been mixed, with some months showing improvement and others revealing persistent price pressures. The Fed is demanding a sustained stretch of good inflation numbers before considering rate cuts. For now, higher for longer is the new normal, even if it means slower growth. The central bank is willing to risk a cooling economy to ensure inflation is truly defeated. Until the data convincingly improves, the Fed is holding the line. Despite high interest rates, the U.S. economy remains surprisingly robust, defying expectations and continuing to show strength, especially in the job market. Across the country, businesses are hiring, and more Americans are finding work, fueling optimism about the nation's economic outlook. While overall growth has slowed a bit from its rapid pace, unemployment remains near historic lows, and wages are steadily climbing. These are hardly the signs of an economy in distress. In fact, many workers are seeing better paychecks, and job security is higher than many had predicted just a year ago. Federal Reserve Chair Jerome Powell points to this resilience as a key reason for patience. With Americans working and earning more, there's no urgent need for stimulus or immediate intervention. The Fed can afford to wait and watch, rather than rush into policy changes. However, this strong wage growth and persistent consumer demand can also keep inflation higher than the Fed would like, making its job more complicated. Balancing rising prices with economic momentum is a delicate task. Many experts predicted that aggressive rate hikes would trigger a recession, but so far, the economy has proven remarkably durable. Instead of shrinking, it has adapted and continued to grow, surprising even seasoned analysts. This ongoing strength gives the Fed valuable time. There's no need to rush into cutting rates to prevent a downturn, as the economy is holding up well under pressure. The bar for changing policy is high. Only a clear and sustained weakening in the labor market would prompt the Fed to act quickly. For now, the data simply doesn't show that kind of trouble. As long as jobs remain plentiful and consumer spending stays strong, the Fed can keep its focus on bringing inflation down to its target, without worrying about derailing growth. Right now, the risk of easing policy too soon outweighs the risk of keeping rates higher for a bit longer. The Fed is determined not to repeat past mistakes by acting prematurely. Ultimately, the Fed is betting that the U.S. economy can handle the pressure, and so far, it's proving up to the challenge. The Fed's independence is crucial, and it's being tested. Political pressure, especially from former President Trump, has mounted, with calls for lower rates to boost growth and cut government borrowing costs. Despite this, Chair Powell and the Fed have stayed focused on their dual mandate: stable prices and maximum employment, not political calendars. Powell made it clear, "Our decisions are not influenced by electoral considerations. Cutting rates for political reasons could reignite inflation and damage the Fed's credibility." By holding firm, the Fed reinforces its role as an impartial steward of the economy. This independence is essential for market trust and effective policy. The Fed's refusal to bow to political pressure keeps its credibility and the economy intact. The Fed's higher-for-longer stance sent shockwaves through Wall Street. Stocks, especially tech and speculative assets, fell sharply as hopes for rate cuts evaporated. Bond yields spiked, reflecting the new reality of persistent high rates. The VIX, Wall Street's fear gauge, jumped as volatility returned. For Main Street, the impact is immediate: mortgage rates remain high, making homeownership even less affordable. Construction of new homes has slowed, and borrowing costs for everything from cars to credit cards stay elevated. Households with debt face more financial pressure, while small businesses find loans expensive and harder to get. The Fed's decision, aimed at long-term stability, brings short-term pain for borrowers. Savers, however, benefit from higher returns on deposits. The ripple effects are being felt across the entire economy. In this high-rate environment, your financial strategy needs an update. For investors, caution is key. Focus on companies with strong cash flows and consider defensive, dividend-paying stocks. Shorter duration bonds and inflation-protected assets like TIPS can help manage risk. Diversification is more important than ever to weather both slow growth and persistent inflation. For borrowers, prioritize paying down variable-rate debt and shop carefully for new loans. Adjustable-rate mortgages may seem tempting, but come with risks if rates stay high. Savers are in a sweet spot high-yield savings accounts, and CDs offer the best returns in years. Moving cash into these options is a smart move in today's climate. The Fed's June 2025 decision marks a turning point. Policy is now fully data-driven. Rate cuts will only come after a convincing, sustained drop in inflation and possibly a weaker job market. If tariffs or strong wage growth keep inflation high, rates could stay elevated into 2026. Unexpected shocks, like geopolitical conflicts, could also keep the Fed on hold. Chair Powell's message flexibility is key, and there's no set timeline for policy changes. For everyone, uncertainty is the new normal. Every jobs report and inflation reading matters. The era of predictable monetary policy is over. The Fed's next move will be determined by the data and the data alone.